Hello, everybody. Welcome to the presentation. I thought what we would do is talk about three kind of major issues that we're seeing from a business perspective point of view in terms of what's happening with this Tax Act that we've been talking about. Terry Cicero put together a presentation earlier on this, and we're reiterating this. This is one of the largest pieces of tax legislation that we've seen, that I've seen personally in 30 plus years. It's pretty wide ranging and pretty important. So there's three sections we're going to go through here. First section will be just sort of covering general tax law provisions as it affects a variety of businesses. The second thing we're going to talk about is accounting method changes. You're going to find that there are some very interesting provisions in the bill that allow taxpayers who previously were on the accrual method of accounting actually to move back to the cash method of accounting and actually help to defer taxes or to match your tax results with cash flow. So that's kind of interesting. And then the third thing is the pass-through entity business deduction at 20%, which is garnering a lot of press. The provision is very difficult. It's largely unsupported by any kind of interpretation or regulations at this point. So we'll try to ferret out what we think the law is going to say. So moving on to the next slide, the first thing I want to talk about is some of these general business provisions. And the first thing that comes to mind is the Section 179 expense deduction. Now, I've listed out here what the rules were previously under the law and now what they are under the Tax Cuts and Jobs Act. And you'll see that the maximum Section 179 deduction has been nearly doubled. It's $1 million now, and thus almost all businesses, large and small, can benefit from this provision. The phase out, the investment limitation, has also been raised to $2.5 million. So what the phase out means is that starting at $2.5 million, your $1 million deduction starts to get phased out. So you actually have a $3.5 million threshold that you can place into service property. And this would be any kind of property, personal property, qualified software, off-the-shelf type of software. And in addition to that, the law has expanded the types of properties that we can now write off via Section 179. So previously, you would have to capitalize roofs. Now that they are allowing a full expense deduction for roofing, for heating, air conditioning, fire protection, alarm systems, and security systems. Previously, all these assets would have had to have been capitalized and written off over a 15 or 39-year period, and now we can actually summarily just do away with the property and expense it and actually save tax dollars. Section 179 does have limitations. The chief limitation here is that your business has to be profitable to use the Section 179. And if not profitable or marginally profitable, or the Section 179 would actually create a loss, then we have a different way to attack the problem, and that's through the use of bonus depreciation. Now, bonus depreciation currently is at 50%, or was at 50%, I should say, now is at 100% of qualified property. And the thing that I want to draw your attention to is notice the placed in service date of September 27, 2017. This is one of the very few provisions that actually affects 2017 returns that we're actually working on right now. So we are on the lookout for when you're actually placing the properties in service. So if you receive a phone call from one of our many fine accountants asking you when you actually bought the property, you'll know the reason why we're asking is because depending on when you actually placed it in service, we can either write it off 100% or 50%. The other thing that's interesting is that it previously applied only to new property. Now it applies to used property. It applies to rental properties, and is going to be around until 2022. And then after that, it starts to phase out. And I've listed out the phase out percentages, which will occur starting in 2023. Bonus depreciation is an excellent way to recover 100% of your cost. So is Section 179. The difference between the two is the bonus, we can actually create a loss as a result of writing off your investment in property, where in Section 179 we can't. I threw together just a very simple example. In fact, I'm working my way through this with one of my client companies right now. They actually placed into service $1,150,000 in equipment. The question that's being asked is, how much of this can I write off right away? The answer is all of it. If you just take a look here, the first year write-off by a Section 179 is $1 million. That leaves $150,000 of basis left. It qualifies for 100% bonus depreciation. Therefore, I get to recover 100% of the cost. And in a 37% bracket, which is what my client is in, it saves them roughly $425,000 in tax. And that's just at the federal level, not to mention the state level. One of the concerns that we had is whether Illinois would require an add back of the bonus depreciation as they did with the 50 and the 30%. We haven't seen anything that indicates that they're going to do this. We actually have a letter on file with the Illinois Department of Revenue asking this very question. Haven't received a response yet. We think there will be no add back for 100%, but stay tuned. We'll let you know for sure. Another major improvement that they made to the tax law is this concept called qualified improvement of property. You know, previously they had three different kinds of property. They had qualified leasehold improvement property, they had qualified retail property, they had qualified restaurant property. And depending on what type of property you had and the requirements that were in place, determined whether or not you could actually deduct the property, and if so, how much. And what they've done now is they've consolidated all this into a brand new provision called qualified improvement property. And this is a much better way of approaching things. They actually, Congress is actually looking and asking the question, you know, do you have non-residential real property? And if so, if it's not an enlargement to the building, it's not an elevator or escalator, and it's not part of the internal structural framework of the building, such as load-bearing walls and beams, but if it's truly an improvement, such as a leasehold build-out or things of that sort, it actually qualifies for qualified improvement property. And the arrow at the bottom I put in bold so that you can see that it qualifies both for Section 179 or bonus. In other words, if you have a lease build-out or if you have qualified improvement property to a non-residential, you're going to be allowed to recover pretty much 100% of the cost of the improvement right up front. Now, from a creditor lender point of view, they're going to look at this and they're going to wonder why they don't see fixed assets on your books, or why they see the tax basis having been reduced down to zero. And the reason why is because for tax purposes, we can write off the cost of the property. There's a question came in, can goodwill purchased in the purchase of a business be depreciated? The answer is no. Goodwill purchased is a Section 179 asset that continues to stay that way under the new law, and that's a 15-year write-off. That is unchanged under the new law. Let's see, luxury automobiles. We garner these questions every year. In fact, I just met with a client on Saturday. They went out and purchased a Denali, and a GMC Denali, for those who are familiar with these large SUVs that weighs well in excess of 6,000 pounds. They've hiked the maximum allowable depreciation limits on vehicles from, in the first year anyway, it was $3,160. It's now $10,000, and they still are giving you the $8,000 bonus depreciation. So the first year depreciation amount on a luxury automobile can be as high as $18,000. Now that's based off of 100% business use. If you're not using the vehicle 100% of the time for business, obviously we have to scale the deductions back. But if you are doing 100%, or if the personal use of the vehicle is included in your compensation, then you are at 100%, and these limits would apply to you. The other interesting thing that's in here, this is going to be more for automobile dealerships with floor plan interest. This is going to be applicable to real estate lessors, REITs, things of that sort that have a lot of mortgage debt, particularly with real property or floor plan interest. The rule is now that the net interest expense is only going to be deductible to, it's only going to be limited to 30% of the company's adjusted taxable income. A couple things to keep in mind. This isn't applicable to everybody. It's only applicable to large taxpayers with $25 million of annual gross receipts or more. I've given you the definition of the adjusted taxable income, but most importantly, this disallowance is going to apply to all businesses regardless of form, regardless of how the business is actually doing or accounting for its businesses, whether that be S corporation, partnership, sole proprietorship, whatever. Now, having said that, there is a way around this disallowance provision, and there's a cost to it. In tax law, there's always good, bad, and ugly. The bad is that we can elect out of this provision and utilize 100% of the interest and claim a deduction for it. But the trade-off is that you have to agree to depreciate the real property over a 40-year life, which some people aren't going to like. So there is an incentive to try to get the mortgage debt paid down and to try to limit the amount of interest expense that a company pays. And we can certainly work with you on modeling this out and seeing how it applies to your business. Another thing that they put in here, Tax Cut Job Act, the like-kind exchanges. It used to be that for personal property, particularly like vehicles, if you traded in your vehicle, that was treated as a like-kind exchange. No longer is the case. Like-kind exchanges are limited only to real property not held primarily for sale. So if you trade in a vehicle now, it's going to be regarded as not as a taxable, I should say non-taxable like-kind exchange. It's going to be regarded as a taxable disposition of the vehicle for whatever the trade-in value is, and then followed by a reinvestment into a new vehicle. So we see this fairly common. So that's kind of new. Well, that is new, kind of interesting. Here's something that a lot of people don't like. It seems like every time we handle an IRS examination, entertainment and meals is always examined. Congress has been dealing with this issue for a long period of time, and now they've come along and they've thrown out a very broad disallowance provision, which just simply says entertainment expenses such as golf, sporting goods, recreational, things of that sort, just no longer are going to be deductible at all. Now, business meals will still be deductible to the extent of 50%. Holiday, office parties, recreational events for employees, things of that sort, so forth, that continues to be fully deductible. It's just the entertainment and expenses, sporting goods, dues, things of that sort, no longer are going to be deductible. Business meals, we point out, still deductible at 50%. The rules regarding substantiation on the business meals still applies. You have to have the 5 criteria met: date, place, amount, who you're with, and their relationship to you, and what the business purpose of the expenditure is. And you have to know that if the IRS comes in and it does an examination and business meals are significant in your business, the IRS is going to take a look at this. Let's see. The other major news in this area, obviously, is the corporate tax rate has been reduced. This is a permanent reduction down to a flat 21%. I put in the materials here, notice this applies to personal service corporations such as legal, accounting, medical, health, actuarial, science, engineering. If you are a C corporation, your tax rate as a personal service corporation was 35%, now has been dropped to 21%. The drop of the rate was actually done to make the United States more competitive with the rest of the world. Prior to this tax reduction, the United States actually had the 3rd highest corporate tax rate in the world, behind 2 other countries. And now we're much more competitive. Notice that the corporate AMT has also been repealed, which is excellent news for accountants since we don't like dealing with AMT. And so, like I said, this is a permanent rate decrease, which we like. Which leads into the next question. Should you be an S corporation, for those who already are, or should you convert to C Corp status? This is a very interesting question because a lot of it depends on what you do with your after-tax earnings, whether the monies be distributed out to the shareholders for personal use or whether they be retained inside the corporation for future expansion, whether or not dividends are paid. The next two slides just sort of lay out S corporation versus C corporation, some of the attributes. Obviously, C corporations are subject to double taxation. There's no basis adjustment that results for the company having made money. Obviously, you get the lower rate of 21%. S corporations, there's a single level of tax, not double level of tax. Your basis gets to track based off of what the company does in income. But then, of course, if you're very profitable, the income could be subject to the highest federal tax rate, which is now 37% under the new law. So whether or not you should be an S corporation or a C corporation largely is going to be dependent on determining your effective tax rate. This is a particular case that we worked on. This is actually about 2 weeks ago, where we have a company, a client company. They have about $1.6 million in sales. They pay the owner $500,000 in compensation. They have $250,000 in other expenses. They're very profitable. And the question was, if we become a C corporation or if we stay as an S corporation, what is the effective tax rate going to be? And notice that in this particular case, and I put my cursor on it right here, you notice the effective tax rate as a C corporation is 24.07%, whereas an S corporation was 29.73%. And the reason why is because there's no dividends being paid out of this company. This particular enterprise is in acquisition mode. They're trying to build a series of business entities, and they are going to be retaining all of their earnings for future expansion and not paying out dividends. And so there's no double level of taxation that is occurring right now. Hence, operating as a C corporation is actually more efficient. Now, having said that, looking down the road with this client company, after they've done acquiring all the companies that they're going to acquire, the strategy will be to then elect S corporation status, age the company for another 5 years and a day, and then actually sell the whole book of business and try to take advantage of the tax rates doing it this way. How that works out for you, we have to work through this on an individual company by company basis. A lot of it is going to depend on how much cash you need to draw out of the company. As a C corporation, you draw it out as a dividend. As a dividend, it becomes taxable to the owner, hence double taxation. And we just have to work through these numbers to see if it makes sense for you. But for this particular client company, it made sense for them to be a C corporation, and that's the business entity model that they've chosen. A couple other things here, accounting method changes. This is interesting. For many years, a number of companies that have, particularly that have inventory or purchase inventory, have had to be on the accrual method of accounting, which means you're paying tax on your accounts receivable before you've actually collected them. Nobody likes doing that. So what Congress did is they carved out a couple of exceptions. They had $1 million exception, and then I believe it was $5 million an exception under certain circumstances where you could retain the cash method of accounting. Now they've changed the rules, and they've said that so long as you satisfy this $25 million gross receipts test, even though you have inventory, and even though you have supplies that would otherwise have to be capitalized, you can now switch to the cash basis method of accounting, which means that we're actually paying taxes on cash that you actually collect, not cash that you're going to collect in a future year. So to use an example, we've done a couple of case studies on this already. Using this, this is a manufacturer, a client company of ours. You can see that they've got $1,350,000 in accounts receivable. They've got some prepaid expenses, and they've got the normal, usual accounts payable, accrued expenses, and state income tax, state taxes payable. And when we actually work through the numbers and we figure out what the accounting method is going to be, and we actually reduce the receivables, the prepaid expenses, and the accounts payable, we actually convert them from $1 million taxable income to a loss on the cash basis, and we actually save them about $401,000 in tax. And this is all legitimate. It's all tax legal to do this. Cash basis method of accounting does allow for some manipulation. There are some things that we can do as a cash basis taxpayer to help manipulate your income. but most importantly, you're not paying taxes on receivables until you actually collect them. We did a second example with the distributor, and same thing, accounts receivable, some prepaid expenses, the usual payables, accrued expenses, state taxes, and for this taxpayer, it actually saves them $222,000. Now, this is assuming that the owner is being taxed at a 35% rate, but it's significant, the savings that can be had. To do an accounting method change is relatively straightforward. It's not easy. It's a little expensive to do because we have to get all sorts of paperwork from you. But what we end up doing is we end up filing paperwork with the Internal Revenue Service, and the accounting method change is deemed to be accepted so long as the paperwork is prepared properly. So this is a fairly straightforward thing to do for client companies that are interested in doing this. The other thing that I wanted to talk about, and I want to spend a little bit of time with this, is the pass-through entity deduction. I've listed out here this deduction. You've been hearing a lot about it. It's a 20% deduction based off of what they refer to as qualified business income from your business, whether it be a partnership, S corporation, or sole proprietorship. Now, there's some limitations on this. The first thing I point out to you is this concept called specified service trades or businesses. If you're a specified service trade or business, obviously you're not going to be able to take advantage of this. Also, this can't create a loss. In other words, you can't offset your income and reduce it below zero. And then we're going to find that there are certain taxpayers, married filing joint, between $315,000 and $415,000 of taxable income. This deduction is going to phase out, and for certain specified service businesses above the threshold, you're not going to get any deduction for it at all. So going through this, I list out here what the specified service trade or businesses include. It's health, law, accounting, actuarial, science, consulting, athletics, performing arts, financial services, brokerage services, and investing and investment management, trading in securities, stocks, bonds, commodities. You'll notice that architecture and engineering is not on the list. So if you are in engineering or architecture, this deduction is a viable thing for you. If you're in these fields of these fields of trades or businesses, then you're going to find that it's going to be largely dependent upon what your net income is in terms of whether you're going to be able to use this deduction or not. So I threw together this slide, which I think is probably the most important slide on this section, is to find where you are in this grid and then apply the law as you see it. So in other words, if you are a specified service business, let's say you're a doctor, and your taxable income, that is the taxable income that shows up on your Form 1040, is below $157,500 for a single taxpayer or $315,000 for a married filing joint, you're going to get the deduction. But that if you fall between the threshold limits, you're going to find the deduction gets phased out ratably, and that if your taxable income is above the thresholds, which married filing joint, for example, is $415,000, then you're not going to get a deduction at all. Now, that's for specified service businesses. Again, that's this column right here. If you're not a specified service business, then you're going to look in this column right here. And clearly, if you're below the threshold, you're going to get the deduction. If you're in between the thresholds, you're going to get a limited phase-in amount. And then if you're above the thresholds, you're going to find that this W-2 property limitation rule applies. And I'm going to explain what that is. The purpose of this law provision was effectively to replace what was on the books previously. What they're trying to do here is they're trying to encourage companies to go out and hire and pay employees. This isn't so much a deduction because the owner is engaged in business. It's more along the lines because the owner has gone out and has either invested in property or he's invested in employees and pays wages. You're going to find that if you view this law with the idea that we're employing people or capital, and if we're particularly profitable, then you're going to find that you're going to get some of these deductions, but that if you're a specified service business, you won't. So here is the rules. You can look at this slide. You're going to find that taxpayers whose income is below the threshold amounts, we don't have to worry about this 50% of W-2 wages or this 2.5% investment in property, but that if you are in between or above the thresholds, then these limitations are going to apply. So to put some examples on this, we ran this through. This is a manufacturing enterprise. Okay, manufacturing is not a specified service or business. So we're looking here, here's in 2017, here's what the tax results of operations were and the tax to the S-Corp shareholder. And here in 2018, you'll see it's the same taxable income, same everything, same deductions, same everything. And we get down here to this 199 cap A deduction, which is basically 20% of what the company net income results were. It's just simply 20% of the K1 income. It's limited to 50% of the W-2 wages. So, the W-2 wage limit is okay. So we get this deduction for $100,000. It brings our taxable income down, and we actually save the taxpayer $47,000 in tax by taking advantage of this deduction. And it's fairly straightforward from there in terms of the calculation. Now, having said that, I point out to you that the IRS announced that Treasury regulations on this, interpreting the rule, will not come out until sometime this summer. One of the things that they also said is that they're going to have an anti-abuse rule, which will be contained in the rules to keep taxpayers probably from splitting up trades or businesses and trying to segregate out a trade or business that might qualify for the deduction versus a service trade or business that clearly doesn't. And I'm thinking of a law firm with their time and billing system, perhaps an optometrist with their sale of eyewear. We would think that, for example, if you were to, as an optometrist, for example, if you were to create a new business and put into the business the retail aspect of the business, the selling of the frames, the contact lenses, solution, etc., selling of items at retail is not a specified service business. Hence, the deduction should apply with respect to that aspect of the business, where the optometrist, the portion being the doctor and the eye examinations, does not qualify because that's a specified service business. And if you're above the thresholds, clearly that deduction would not apply. Ditto for a law firm. Consider putting the billing system, for example, into a separate business and have that bill out, maybe not just for that law firm, but possibly for other law firms. And then that business, clearly, time and billing management has nothing to do with the practice of law, therefore might qualify for the deduction. So having said that, we don't know what this anti-abuse rule is going to be. We don't know if they're going to make reference to the single employer rules, which would aggregate. They would look at the employees of the separately spun off business versus the service business and say, well, look, if you're covering the same employees through the same pension plan, that the businesses have to be aggregated. We don't know if that's going to happen or not. So stay tuned for that. That will be coming out this summer, and we'll be issuing guidance on that just as soon as we get the guidance. To do another example, here is a consultant working through the same thing. We're going to see that because a consultant is a specified service business, and I know your question is going to be, well, who is a consultant? That question is very nebulous. If you bill out by the hour, much like an accountant or an attorney, chances are you're going to be found to be a consultant. If you are more along the lines of sales of product, for example, you recommend install computer systems, things of that sort, chances are you're not going to be regarded as a consultant. In that particular case, because this gentleman is a consultant, because his income is above the threshold, this is actually going to cost him $21,000 in tax. So that's the presentation that I have here in a nutshell. And I'm wondering if there are any questions regarding this. Obviously, you can reach me at my email or give me a phone call, and I can try to help you through this. But that's the presentation that I have for today. And if there are any questions, feel free to let me know. And I thank you for attending.